Certainly, but I think a lot of your work has to do with reducing risk. And with your background as a wealth manager, you look at the Sharpe ratio as well. How, what kind of reward you can get while having the lowest risk. And you've analyzed also having gold in your portfolio, and it seems like practically every if we look at the prices throughout recent history, pretty much every single option of different portfolio allocations, it's always good to have gold in your portfolio. And it does depend on the time frame, but one of the best allocation that you found was not a 60-40 traditional or conventional stock bond portfolio, but it was better to replace some of the bonds with gold. And even it seems like one of the best ones you had was 60% stocks, only 10% bonds, and 30% gold, which most wealth managers would be like, what in the world? That's a huge over allocation to gold. But for at least the time frame that you were looking at it, it did very, very well. Can you expand on how replacing gold or replacing bonds with gold really is a better long-term play?
Yep. So first of all, the optimal asset allocation very much depends on your start date. So if you start in 1970, the optimal asset allocation is different from your optimal in 1975, different from 1980, and different in 1990, 2020, and so on. So depending on your start date, the optimal asset allocation will be different if you're looking forwards over time. And I've done hundreds of tests, and I have a portfolio simulator on my website called Clive Thompson, which anyone can go to. It's free of charge, no registration, not even an email address needed. And you can put in any asset allocation you like to test this. You can put in any starting date you like to test this. But the conclusion is the following. Over virtually any period, i.e. any starting date until today, having some gold in your portfolio would have improved its return, it would have improved its Sharpe ratio compared with the traditional 60-40 portfolio, and it would have reduced the biggest loss. That's a peak to trough cycle. It would have reduced the biggest loss from whatever it was to a smaller loss if you had gold. Now, the optimal amount of gold does somewhat vary according to your starting date, but what I can say is, had you put in around 30% of gold at any time in history, it would have improved your portfolio compared with a 60-40. So 60-40 would be 60% equities, 40 bonds. If instead you'd had 60 equities, 30 gold, and 10 long-term bonds, you would have done better on all the metrics. Now, it doesn't mean to say that every single date in history, 60, 30, 10 was better than some other ratio. But what it does mean is having some gold. So, for example, in the last 5 or 10 years, the best ratio would have been more like, I can tell you, I've got it in front of me here. If you started now, if you started in June 21, that's 5 years ago, your best ratio would have been 35 equities and 64 or 65 gold. If you go back 10 years before that, it would have been 65 equities and 35% gold, zero, in both cases, zero bonds. But as I go back in time, let's say to 1991, the correct ratio would have been 48 equities, 23 bonds, and 28 gold. But overall, 30% gold would have been the perfect number if you couldn't choose your starting date.
And it sounds like you're using the computer essentially to calculate, thousands and possibly hundreds of thousands of different combinations for different date ranges. So it's not just like picking a couple here. It's actually like looking at pretty much all the different permutations you could think of.
Well, I've looked at on the 3 asset classes, gold, bonds, and equities. I've looked at every date range up until 2021. When I say up until 2020, there's not a lot of point in looking at beyond 2021, because beyond 2021, the optimal would have been 100% gold, to be honest with you. But up until 2020, so starting from 1970 or 1980 or 1990 or 2010 or 2020 or 2021, all of those dates, you should have had gold in your portfolio with hindsight to improve your Sharpe ratio and other things like your performance or your drawdown. We can optimize that by changing the asset class. So on my website, you can put in any asset class you like. You can put in emerging market bonds. You can put in emerging equities. You can put in real estate, US real estate. You can put in UK real estate. You can put in the UK index. You can put in probably about 25 to 30 different asset classes, including Bitcoin, and silver is there as well. So you can choose your asset classes, add your mix, add your percentages, and you can choose whether to rebalance monthly, quarterly, annually, or never. You can choose whether there's a fee comes out, because real life portfolios have a fee, including taxation, if you like. So I put in a fee of 1 or 1.5%, which is taken in installments every 3 months. So you can put in a fee when you do simulation, but you can simulate basically anything, and it will tell you what your return is, what your Sharpe ratio is for any portfolio, what your biggest loss would have been, and it will show you month by month how your portfolio evolved, and it will compare it with any benchmark you choose. You can choose a benchmark of S&P or a benchmark of gold or benchmark of Bitcoin or whatever you like as a benchmark, and it will compare your performance with the benchmark.
And I think this is, again, completely in contradiction to what the majority of conventional wealth managers are doing. They have almost practically nothing in gold right now, and they think that gold is this crazy, extremely volatile, risky asset. But as you've demonstrated, it actually having a good portion of your portfolio in gold, at least based on the data that you have from what we have from the past, is actually better and reduces your risk and increases your reward. And I guess, what is your take on that? Because a lot of people say, it's too risky. Gold is in a bubble right now. But you've mentioned before how actually that doesn't make any sense, because it's extremely under-owned at the moment. No one wants to touch it. If you look at the majority of conventional wealth managers. So what does that say about how they're wrong? And then also, what kind of, where are we in the gold market? It seems like definitely not the popping of a bubble at the moment.
Well, first of all, unless we find an asteroid full of gold, and I don't think there's much prospect of that, gold is not going to go to zero. So in that respect, it's the safest asset you could have in your portfolio. It's safer than a bank deposit, which can easily go to zero due to the counterparty risk. It's safer than some of the largest AI-related companies. Let me give you an example. The fees that everyone is paying, and it's only about 5% of those who are using AI who are actually paying fees, the fees aren't even covering the electricity costs. So people are paying in $50 billion a year to the AI companies for the usage of AI, but the electricity costs are coming in way above that. And on top of that, they're incurring this year $800 billion of capital expenditure, which next year will be $1 trillion of capital expenditure. The year after will be $1.2 trillion of capital expenditure, according to the predictions, compared with this revenue which is coming in from users of, let's call it 50 billion for simplicity, which is a tiny fraction of what they're spending. Now, capital expenditure, of course, is, in inverted commas, supposed to be an investment which generates that revenue, but that revenue isn't covering the electricity cost at the moment. So every big AI company is going hell for leather to try and sell their services below what it really costs in order to maximize users, maximize usability. So they're all working like crazy to train their models, to produce better and better models. They're going crazy to get the data centers running. They're buying the best NVIDIA chips. And all of this, the data centers, the training, the NVIDIA chips, all of this must have a depreciation rate. What if they never get, let's say some of them never, and I'm sure this will be the case, some of them will never get to profitability, and the users go away. What have they got left? What's it worth? Well, the answer is worth very little, and they might, in fact, become insolvent, some of them. So they could go, even these wonderful companies potentially could go to zero. Your gold price is not going to go to zero. But there's another factor which is quite important. Even if equities do rise and continue rising, which I think they will, you constantly have to be on the ball with equities. You have to be thinking, where should I be parked now? Should I be in the AI sector? Should I be in the utilities? Should I be in the oil sector? Should I be in the medical sector? Should I be in America? Should I be in Europe? Should I be in emerging markets? Should I be in Asia? You have to move it around. Those are taxable events. If you have some gold in your portfolio, you don't have to move it around. You don't have to be thinking, I'm selling it this year, buying it back next year. Because your risk of it going to zero is not there. You could just keep it forever and ever and ever. And because you're keeping it forever and ever, your tax bill overall goes down because you're deferring your tax until some distant date in the future when you might well be dead before it ever has to be sold.